Hi, this is Ann with Finance on the Offense, and today I'm going to go over what meme stocks are and whether you should invest in them or not. Now, I am not a financial professional or anything like that, and everything in this video is just for entertainment purposes only. All right, let's get started. So what is a meme stock? This is actually a brand new term. Up until really recently, stock movements, like basically whether the stock was going up or down, depended on a lot of different things, like how well the company was doing, whether there was good news or bad news about the company, and lots of other factors. And one of those factors is also speculation. Sometimes big hedge funds and financial institutions make so many trades, buying or selling, that it actually affects the stock's price. Retail investors, or investors like you and me, don't really move the needle that much when it comes to affecting share price. But now, thanks to Reddit.com and Wall Street Bets, which is part of Reddit.com, it's a forum, because of Wall Street Bets, huge numbers of retail investors like you and me are banding together and buying a stock, which increases the trading volume of that stock by a lot. And it causes the share prices of those stocks to go up. And that's what a meme stock is. So in a nutshell, a meme stock is one of the stocks that has seen huge trading volumes because of retail investors like you and me coming together on Reddit and all buying the same stock at around the same time. This causes the supply of shares to go down, and so the demand increases and therefore the share price increases. And it's all manipulation. The stock isn't a better stock after this happens to it. It's just more expensive to buy. Now, if you're wondering why they're actually called meme stocks, memes are images like these that are basically a picture with funny text. They're hugely popular on Reddit.com, and they have been for years. Now, some of these stocks get popular on Reddit.com because there are people on there who know how to analyze a stock, and sometimes they notice that a stock has a significantly higher than 100% short position. Now, I go into a lot of detail about what that means exactly in my GameStop stock video, which is on your screen above in the link, if you want to check that out. Basically, big companies are shorting the stock or betting against it, and that involves borrowing the stock. The stock analyzers have noticed that there are more borrowed shares than actually exist. And when the Redditors notice this, they alert the Reddit community and everyone jumps in to buy the stock. That kind of causes the stock to go viral and basically become a meme stock. This in turn causes a short squeeze, which again, long story short, causes those big investors to lose a ton of money. So let's go over some of the meme stocks out there. First up is GameStop. Let's look at a chart for what's happened to that stock in the last year. In June of last year, it was at $4.83 a share. Right around here, it became a meme stock. It jumped up to $347 a share. So if you'd put $1,000 in GameStop here, and sold it today, your $1,000 would have turned into $45,341. AMC stock is another meme stock, and this is the chart for the last year of this one. If we'd bought $1,000 worth of AMC back in June and sold it today, it would be worth about $11,450. Next up is BlackBerry stock. If you'd bought this one last year, it would have cost about $4.92 a share. And if you sold it today, it would be at $13.14. So if you bought $1,000 worth back then, your $1,000 would be worth $2,550. And then finally, Nokia. Here's the Nokia chart. If you'd bought $1,000 worth of this a year ago, it would be worth $1,168 today. Now, there are a lot of lesser known meme stocks, and here's a list of a bunch of those. Now, most of these I have never heard of, but some of them are pretty famous, like Express and Bed Bath & Beyond. Now, meme stocks are looking pretty tempting, aren't they? But here's the thing. I've been talking about the more successful ones, and there's a lot of pressure on Reddit to have diamond hands, meaning don't sell the stock, hold it forever. These stocks are so volatile. It's common for them to lose or gain 15 to 20% in just a day, and they can hit rock bottom just as fast as they jumped. GameStop went from $347 a share to $41 a share in just a month. If you happen to buy at $347 a share, thinking, oh, this has been rising and rising, I'm just gonna jump in now, and then it'll go to $2,000 or something. And then as it was falling, if you decided to sell at $41 a share, thinking it's just gonna go down to zero and go bankrupt, your $1,000 would have turned into $118. So because of the volatility, you might be tempted just to not check it at all, because you don't want to panic sell if it's doing badly. But here's the argument against that. These companies, the meme stock companies, generally aren't that great. Most of them have major issues and have had declining share prices for a long time. And that's why the big financial institutions are shorting the stock and basically betting it will fail. So in my opinion, you want to be watching the stock every day just in case there's a huge spike and you think, well, maybe I should sell now and get out while I can. These stocks, in my opinion, are not stocks you want to hold forever. But if you do watch them every day, get ready for a roller coaster ride. My husband and I bought a little GameStop and AMC back in January, and this was after they had had their really huge spike up in price. And we saw they were falling every day, and we decided to buy. I think GameStop was right about here at $141, and AMC was at $9.75 or something. I wanted to sell pretty quick because I don't really think that GameStop is the greatest company, and AMC I was a little more confident with, but then the price kept falling and falling and falling, and it was definitely hard to see that every day. I kept thinking, well, maybe we should just sell now at a loss before these actually go bankrupt and go to zero. But we didn't sell, and in March they both spiked up again a little bit. We ended up selling then and actually made a little bit of money on both of them. But it definitely showed me that I do not have the stomach for that kind of volatility. So I plan to stick with index funds from here on out. Not that you can't lose money on those too, but they definitely don't feel as volatile as meme stocks. So if you feel comfortable with the amount of volatility that these meme stocks have, I say go for it. But if you're like me and you want a little more security in what you invest in, it's probably best to just invest in index stocks. All right, I hope you liked this video. If you did, please click on the like button, and I'll see you next week with another Finance on the Offense video. Thank you.